Barrel rolls is the reporter thrown into the secretive world of the Forex Super Model, where nothing is as it seems. Beware the techno-monk, and steer clear of Professor Code and his two assistants. Give the senior trader a wide berth, and don't expect any sense from the risk manager.
I'm the senior trader for the Forex Super Model, and this is the continuation of Trading Psychology series part 4, which we're going to title up as the Day Trading Paradox. So, the day trading paradox then. So, a lot of you are day traders, I understand, and there's nothing wrong with day trading. You've developed a method to trade the markets on a daily basis. So from our perspective in this organisation, the Forex Super Model, we're looking at all different types of traders, obviously from a psychological point of view, and we're attempting to exploit their weaknesses. We need to know what their strengths are, and in order to do that, we analyse the way most of them work, and we come up with our own model, if you like, or our own vision of the way we believe day traders work. Obviously, there's tails on either side. Not all day traders work the same, but there are some common themes. Now, day traders, generally by definition, they start the day with a fairly blank sheet of paper. You could argue that the better day traders have done some prep work, so they might have done prep overnight or early in the morning before the market that they're interested in opens, or when their time frame is. So you could argue that, but generally each day is a blank canvas to them, and what they're trying to do, the whole purpose of day trading is to exploit daily moves and control risk, really. So it's sold to you on the basis of you're controlling. So control risk. Risk management is quite often placed at the core of day trading, and if you go on courses, they sort of really bang on about risk management, which is fair enough, because if you've got poor risk management, particularly as a day trader, you're likely to blow up your account. So the better day traders do some prep. They have a blank canvas. They look out for patterns, but basically what they're trying to do. So if you look at a day in a particular market, you've got a daily range, which is the ATR, the average true range of the market, which if you look on a daily and you look at the average true range, what they're trying to do is link trades and exploit a series of average true ranges. So they're trying to add together average true ranges to make up a series of trades, maybe through the day, which add up to the parts add up to the greater than the whole. So the average true range, say, of the euro dollar maybe 90 points, and the average true range of the pound yen could be 140 or something. So they're trying to get in and accrue these average true ranges in their trades at the same time as controlling risk. Now, that obviously leads to certain behaviour patterns, and The bottom line is if you're a true day trader and not a vegetarian who only eats fish, which effectively, you know, that then if you're a true day trader, then you only trade intraday. So there's no buts. You don't run trades overnight. You don't run them over the weekend. You literally trade intraday as a true day trader. Now that sets you up straight away. So if you're trading intraday, then that puts you in a certain bracket. So, and as I say, you know, the default day trader on a long trade has an entry, a take profit and a stop. Let's suppose they've got a stop of 20 points, a take profit of plus 40, and they're looking at greater than equal than 2 to 1 risk reward, and their overall position size will mean that if and when they lose their 20 points, they will be risking a maximum of 1% of their account size, so less or equal to than 1% per trade. And a little bit more sophisticated than that, possibly they can say that they won't have a worse day than greater than equal than 3%. So they're not going to link. They're not going to link more than 1% trades together in a day, week, or whatever. So that if they're having a bad day, they know that they're top limited to 3%, etc., etc. Now, that's all very well and good, and you know, and you can argue that it's all very sensible, and of course it is in many respects. But as I say, we're looking at exploiting day traders, or actually understanding how they're going to react. So what have we got then? So and day traders basically are looking for they're either looking for breakouts, so you know, they're looking for breakouts, they're looking for range trades, support and resistance. So they'll go, if they believe the market is in a range, they'll go long at support and short at resistance, etc. So breakouts, range trades. Then you've got some momentum players. So you've got momentum players. And what else have we got? We've got excuse me a minute. We've got momentum players, yes, and we've got retracement traders. Retracement, a bit of brain fade there. Retracement traders who are looking at uptrends and then getting in on a retracement. So that would be a long, and then that would be a short. So that is pretty much the bulk of their strategies in terms of, I mean, obviously there are variations on the theme, and there's other strategies, but you know, most day traders are either looking for breakouts, they're either looking at ranges, or they're trend style day traders looking at momentum, and and you could also link that into retracement traders. So they're looking for a pullback on an uptrend or a pullback on a downtrend. Now, obviously, this is valuable knowledge if you're you know, looking at trading psychology, and if you're a market maker or whatever. So that's where we're at. And then if we go a little bit further, we say that the core really is they're looking for a lot of them are looking for patterns, and they're using indicators to ascertain what type of market they're in, and entries and exits, etc. So patterns could be things like double tops, head and shoulders, and then you've got indicators. You know, the most common ones without doubt are RSI, relative strength index, MACD, MACD, and then you've got ADX. That's a very common one. Average directional index, and then so the RSI. You know, there's a lot of interest around the 50%, the 50 mark on it. So when the we know from a psychological point of view that if the market breaks the 50 line, then the breakout traders are going to start to become interested, because it's an indicator of a breakout, if you like, or of a move. And if it goes below the 50, likewise. MACD, a lot of people are looking at divergence. And the ADX, you know, is it an uptrend or a down? So you know, if it's less than the standard thing is 30, it's a downtrend, and if it's greater or equal to than 30, it's an uptrend. Now, so that's basically a whistle-stop tour of the bulk of the framework for day trading, if you like. So day traders are looking for patterns. You know, if they want to look at more sophisticated, they look at flags and hanging men and all this stuff. And then indicators. They're probably, and then you've got moving averages, obviously. So moving averages, and the common moving averages are 20, 50, 100 and 200. And then, you know, the normal argument is should you be using EMAs, exponential moving averages, TMAs, triangular moving averages, or SMAs, simple moving averages? And the answer is, well, it doesn't really matter, it depends how you're using them, but day traders tend to like EMAs and SMAs. Not many are using TMAs. Now, EMA tends to weight earlier data, so this is like earlier, so it's early. SMA tends to be later, tends to be a slower lagging one, and TMA is middle. So if you know that most day traders or traders generally are looking at 20, 50, 100, 200 moving averages and the EMAs and all the rest of it, then you're well at it again. So let's just get rid of this. So this is the infrastructure of the day trading world, if you like. What we've done there in fast time is the bulk of the day trading world. Now, So from there we can say, right, the fact that I can stand here and knock that out, all that information is basically default 101 default information for the markets. Anybody who's spent any time in the markets knows that information. It's common currency, it's well known, and therefore the behaviour of traders, of your rank and file trader, is well known, and the market makers and bigger players are obviously well aware of this. And then when you factor in the economic calendar, for your data prints. So you factor that in, then they pretty much know the way the majority of day traders or traders are going to react. And then of course they're in receipt of order flow information as well, so they can see, or may be able to see or work out where, whoops, done it, there you go, that's the chalk gone, where TPs are, where stops are. So really, if you're playing poker and you're a day trader, you've basically got your hands, your cards you're holding your cards the wrong way around. Every other player can see your cards. You have to look over the top of your cards to actually see what cards you're playing, because you're literally playing to a very defined, structured set of rules, which are sort of rank and file. They've been drummed into you. They make perfect sense, but, and it's a big but, that is the main weakness of the default day trader. Is that, well, A, it's their structure is very rigid, and B, the market players know, like I say, if they know that traders are going to have to be in and out in a day, and if they know that their position size is relative to their account size, then their stops are relative to their account size and their position size, then they pretty much know how much pain you can take before you control your risk. And by controlling your risk, obviously, it means you're being stopped out of the trade. So you're literally, as I said, playing poker with the cards facing the wrong way, and that is the main Achilles heel of the day trader, is that they are very obvious as to what they're doing, what their positions are, how they're likely to react. I mean, obviously, if they start changing, with stops, if you start moving your stops and you start changing your risk reward criteria, and you start changing your 1% rule, so you sort of go on the old tilt a bit, so you start breaking the standardization rules, then obviously you're less predictable, but then you're moving away from your controlling your risk criteria. So they know that anybody who engages in that to a certain extent is more likely to blow their account anyway, because if they're at 1% trade size originally, and suddenly because the trade's going against them, they're up to 3, 4, 5%, or maybe they're adding to losers, then suddenly they're up in the sort of 15, 20% margin of their account, and their leverage is very high, and therefore their account is very much more in danger of blow up. So that's one thing. And the other thing, of course, they know is that they know that people have been trained to put stops at certain points, so stops, and in some ways worse than that, they know where people are likely to put break-even stops. Now break-even stops are in a way a gift to the outside world, because for the day trader they make perfect sense, possibly because in your mind you're in for free. The trade has risen to a point where you can if you're in a long trade you can move your stop to break even, and then no matter what happens you're going to come out of the trade at zero or with a profit at your TP. Now that's great in theory, but of course what tends to happen is a lot of these trades retrace and they chop, and if you're and you quite set and it only needs to chop down to there and you're out of quite a good trade. You've got break even, so you say to yourself, well, it's a semi job well done because it's not cost me anything and I had the chance to make money. Well, that's fine, but what you've done there is you've got rid of a potentially profitable trade at zero, and then when you have the rest of your trades which may well hit your proper stop, then you end up with a zero on a semi good trade and a loss on your normal loss trades, and therefore you've sort of reduced even more your chance of getting into a long-term profit situation. So by screwing it down and reducing the risk even more, you've probably taken away a little bit more of a chance of being a long-term profitable trader, and that's the psychology of it in a way. And then the other things, you can have trading stops. Now trading stops are quite popular, but the problem with trading stops, if you put it, I don't know, 5-10 points behind the market price, or behind behind the market price, then like if you get this chop again, you're only in an ATR probably for 40-50 points if you're doing well, and if you take a 5 or 10 points out your trading stop, you really are going to end up with relatively low reward, maybe 15-20 points if you're lucky on a good trade. So trading stops are, if the market's really screaming and it's spiking, that you could argue they're a good idea. Or if there's a data print and it spikes and your trading stop knocks you out much higher, then arguably that's quite a sensible thing to do. But they have a lot of downside to them as well, trading stops. And just a quick word about the so-called guaranteed stops. Well, you're paying a premium for a guaranteed stop because normally a stop is vulnerable to a gap, a market gap, and if your broker is allowing you to have a guaranteed stop, they're taking that gap risk on for you. So and then of course you may think, well, I'm guaranteed now. Yes, you are, but if the market has gapped and it goes moody, you're in a situation of counterparty risk, which is in a whole new regime. Really, it's basically, is your broker going to be around to pay you your guaranteed stop? So nothing is, as they say, is free lunch. So you're, even if you have a guaranteed stop, you're in the counterparty risk. You're relying on your broker not going bust, which is a fair bet anyway. But there are situations. The Swiss franc a couple of years ago when they took the peg out was obviously not clever, etc. So let's sum this up then. So the day trading paradox really is that if you're a day trader, you've got a nice structure and a risk reward. You're in the market, you're hopping in and out of the market on a daily basis, you're comfortable, you know where you are, when you're hopefully avoiding all the sort of big problems that longer term traders have. And that's how it's sold to you, and you're if you've been on a course there, they've shown you how to do all the entries, the take profits, and it's all a nice. It all seems like a highly professional day trading system, and indeed it is in that respect. The problem with it is that it's too respectful. Everybody knows what you're doing. The people that matter know what you're doing. And like I say, the best analogy I can give is that you're playing poker with the cards round the wrong way. And that is a fair analogy, I think, for most people. But that, I'm not trying to put you off day trade. Day trading has its exponents, and some people are doing very well on them. But from our psychological perspective, we were going to call this video "Day Traders Are Easy Meat," but we didn't. We called it the day trading paradox. So that is basically the day trading paradox. Is that on a micro level, it makes sense, and on a macro level, you may well be holding your cards round the wrong way. So, hope this has been useful. Thank you very much.